Ladies and gentlemen, good day and welcome to the conference call for Arvind SmartSpaces Limited's discussion on financial results for the quarter ended 31st December 2021. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touch-tone telephone. Please note that this conference is being recorded. I now hand the conference over to Ms. Krishna Patel, Christensen Advisory. Thank you, and over to you, ma'am.
Thank you, Rochelle. Good evening, everyone. On behalf of Christensen, I welcome all participants on the Q3FY22 Earnings Conference call of Arvind SmartSpaces Limited. We have with us today Mr. Kamal Singhal, Managing Director and CEO, and Mr. Ankit Jain, the Chief Financial Officer of Arvind SmartSpaces Limited. Please note that a copy of disclosures is available on the investor section of the website of Arvind SmartSpaces Limited, as well as on the stock exchanges. Please do note that anything said on this call which reflects the outlook towards the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. With that, I would like to hand over the floor to Mr. Kamal Singhal for his opening remarks. Thank you.
Thank you, Krishna. Thanks a lot. I am also joined by Mr. Avinash Suresh, who is the COO of the company in this call, along with Ankit Jain, who is the CFO. A very good evening to all of you, and thank you very much for taking time and joining this call. As I can understand, this time there are quite a few people who have joined the call for the first time. So I find it appropriate to spend 5 extra minutes to explain and tell a little more about the company for their benefit, and then we get down to the normal business of telling about the real estate and smart spaces business. We have some very, very strong relationship with landlords and with other stakeholders. That's one of our strengths. We have a comparatively smaller base still, and as you know that once you are done with your working capital requirement, which is the case in our case, raising bank money for growth is a challenge. That's one of those challenges that we face. If you are not deficient on working capital, and if there is nothing to bridge as far as project completions are concerned or the working capital requirements are concerned, RBI guidelines and otherwise, it's very challenging to raise funds from the formal banking channels. But nevertheless, that basically is one challenge that we are trying to overcome through various initiatives like your HDFC platform, HDFC coming in the form of being a strategic partner and having alternate sources of money to fund our growth. As we speak, the debt levels are so low, they are negative as such. We have a huge opportunity to use this headroom to fund our growth for the next cycle of investment. Industry has been consolidating, as we all know, due to RERA and various other reasons. Cash flows have been tight post several crises that the industry has faced, and hence the number of active developers in the market have gone down dramatically. One estimate says that the active developers in major cities have gone down in excess of 50%, and some cities it could be 70%. So if there were 100 developers operating, today maybe there are 30 to 40 in many markets that are operating. So this consolidation means two things. One is that the sector is generally looking up, and consumers are looking forward to investing in real estate not only as an asset class. That's one part of it. But the other part is that house is now seen as something that is a must. That is something that is more than investment. That's consumption and investment together. So there is post-COVID and during the COVID, people have realized the importance of having their own homes, and that means generally there is a demand push, and this push is not short-term in our understanding. We've been seeing this push for the last several quarters, and we always believe that this is here to stay. This is a sustainable trend. So this is one source of growth for the industry in general. But the other thing that we are seeing is this consolidation side of the whole process, where even if industry grows at X, as far as organized corporate developers with brands and track record, I think they will see a 2x growth. because they will have both the benefits coming their way. One from the industry growth in general, which is quite sustainable and looking up after a long time. And the other is the consolidation side of it, which obviously benefit this specific class of developers. And we are clearly seeing these tailwinds coming our way, the way we have been able to do whatever we have been doing the last few quarters. So that's as far as the strengths and some of the challenges are concerned. The company clearly has some very important competitive advantages. Just to name a few, land sourcing has been one of our key strengths. We have a very, very strong BD and land sourcing team. Most of our land deals, in fact, all of them have been possibly benchmarks in the way they are structured, in the way we have been fair to the landlord, and the way they create value. I mean, the focus is on creating value rather than sharing, to maximize the share, etc. And we've been able to source some wonderful deals and wonderful land parcels. We continue to do that. Our investment cycle slowed down in the initial phase of COVID because of various uncertainties, and obviously it was a natural reaction to say that, okay, we'll hold investment for the time being before the uncertainties sort of, thin down. But now we're in the mode where we are actively now expanding our pipeline, and quite a few announcements have been done. And this quarter, we announced a large deal in Pune, which marks our beginning of major investment cycle in that region. Second important competitive advantage that we have is very, very successful partnerships throughout the group and within real estate business. And all our JDs and JVs are very successful. We have very, very healthy relationships. People are keen to invest once again with us on JDs and otherwise. So it's been in our DNA, and this is how we know the business to be conducted for the benefit of not only us but also our partners. We have a very, very strong execution team. We are delivering everything on time. Till now, we have delivered quite a few projects, and all of them have been 100% on track. As we speak, all the projects which are underway are significantly ahead of time on delivery. So there are no concerns or anxieties on deliveries till date. We definitely take up project in a very, very conservative way when it comes to evaluating and selecting a land deal or a project deal. Value for money is something in all categories, be it affordable or mid-priced or luxury. We always are very careful about making sure that an equivalent branded player, we don't compete with the locals, but we do compete with the best of brands in our industry in the micro markets. And there we ensure that if X was our competitor, or similarly the seed and branded player, we leave at least 10 to 12% of money on the table and try to offer a little bit more in terms of specs and designs, etc. Ahmedabad, for the benefit of all here, Ahmedabad is the architectural capital of this country. We brought so many firsts in the country, and it has evolved significantly ahead of many markets that we see around. For example, we are doing quite a bit of work in Bangalore, and we do a lot of work in Ahmedabad. Of course, Pune has started. If I were to compare the two markets, I'll put Ahmedabad at 150 on a scale of 100 if Bangalore was 100 when it comes to designing the facades, the way the designs have evolved, etc., and many big names, including Mr. Doshi, B.V. Doshi, etc., they actually hail from this city. So that brings a very, very specific attention and focus on design and aesthetics and look and feel, etc., when it comes to building design. And of course, we are here to leverage Arvind brand, which has a very, very long history of being a very credible name and brand in a lot of businesses that the brand is involved in. The presentation which you might access from the website, the investors presentation, it will tell you the trajectory of growth in various things. For example, our fresh sales has been growing at a CAGR of around 49% in the last 5 years. It was around 73 crores in 16, and it has reached 529 crores last year. And we target obviously and hope that we'll be able to cross this easily this year as well. Same way, our EBITDA has grown from 25 crores in 2015 to 89 crores in 2020. 21 was a little bit of a blip because of disruptions in various things and scale, etc., due to COVID first wave. But otherwise, there as well, we've had a very, very healthy growth. Our PAT has moved in a similar direction from 11 crores in 15 to 39 crore number in 2020. Going forward, a bit of information about how we look at the markets from here onwards. We definitely want to continue our focus on residential development. That's one. And that's our kind of way of remaining a little conservative, at least in the medium term. We said we will be leveraging one aspect of de-risking the business. Residential focus is another in our understanding, where the capital requirement is comparatively low, and it's less kind of cyclical in the form of demand, supply, etc. And hence, it makes more sense at our life cycle or our life stage to have more focus on residential. And that's what we are doing. We have been very, very conservative about geographical expansion, mainly into the assumption that every geography is a new business. It's not cutting and pasting, or it's not copying and pasting. Every new market needs very, very different kind of responses to very different kind of situations and ground realities. And that's how we have been doing business. Like we started long in Ahmedabad, then we expanded in Bangalore. We penetrated quite a bit in Bangalore. Obviously, there's a lot of scope. We have to multiply there, and that's what we are trying to do right now. But having said that, the third market naturally for us was Pune and Mumbai, because that's the customer mix. That 50 to 100 lakhs and some sort of a premium blend of this makes sense in these two cities as well. But we ensure that rather than jumping into the market, we took up a project, wetted our feet there, went through the grind, understood a lot of ground realities, regulations, and other things, and we are now very conversant in the business as usual. So for the benefit of the newcomers or the new joinees in the call, we are Arvind SmartSpaces, part of the Lalbhai Group, which has a legacy of more than 120 years, possibly one of the oldest business houses of this country. We got de-merged from Arvind Limited in the year 2015. Before that, we had been operating as a division within this company, the flagship Arvind Limited only, and we got de-merged in the year of 2015, became an independent entity, so to say. Primarily focused on residential development, but within residential development, we have a very wide spectrum of products and services that we offer to our customers, which includes a large, medium, and small size of projects, horizontal, vertical, every type, which includes some very, very large township developments, very high-end villas to medium-priced villas to apartments which are low-priced, which are medium-priced, and which are luxury apartments as well. So we cover pretty much, a very, very wide spectrum of residential products. Right now, primarily focused on Bangalore, Gandhinagar, and Ahmedabad. Pune, we started our business some time back, and to just have our feet wetted there, we did one project which is currently underway. This has helped us in understanding business there, the environment there, the regulatory challenges there, and in general to understand the marketing in a little more detail, Mumbai and MMR and Pune. We've gone through that grind, and we now believe that it's time for us to take a significant step forward and expand geographically in the city of Pune and MMR. And in that process, we just rolled out our major investments in these cities as well. So this is as far as our product and customer segmentation is concerned. We have had a very important relationship which got going with SDFC Capital. SDFC Capital, after having invested in a platform deal with us pre-COVID, have now finally joined the company at the equity level itself in the parent company, which is Arvind SmartSpaces Limited. They've picked up a little less than 9% equity into the company. This is one of those rare investments from SDFC Caps where they have invested into a parent company as an investor, so to say. The company has been on a small base growing very, very consistently. Last 5 years have seen a very consistent growth of anywhere between 30 to 50% in various important variables and parameters, which we'll come to in the later part of the presentation. Moving on, just to take you through the timelines of the company, in 2015, as I said, we got demerged from Arvind Limited. First infusion by promoters happened in 2016 through a preferential route. Then again in 2018, promoters infused further money. In 2019, we announced a strategic partnership with LPC Capital through platform investment. So to say it was an equity platform, mind you, or a broadly an equity platform. Generally, they would tend to do structured debt kind of arrangements with developers on a platform basis, but this was truly, in the sense of it, an equity thing where distributions are happening or supposed to be happening based on a waterfall mechanism. If we earn, they get X, and we get our X plus the sweat, so to say. In 2021, we crossed the first milestone of 500 crores of fresh sales, despite disruptions due to COVID and otherwise. And this year also, we are on track to register a healthy growth from there onwards. We issued 7.4% equity to the KMP as well in 2021, and obviously in the same year, this preferential allotment to HDFC and promoters happened. As far as promoters are concerned, this was the third infusion, so to say, from them in the year 2021. Coming back to the business, as I said, we are primarily focused on residential. Pretty much 97% of what we do is residential, and within residential, around 70-71% is mid-priced. That's where we do a lot of business. So our sweet spot has been a 50 lakh to 1 crore ticket in the cities like Bangalore, Ahmedabad, Pune, etc. And 22% is luxury. By luxury, we mean some kind of products which are in excess of, say, 3 crores to 5 crores. In the city of Ahmedabad, we have a few projects where we sell units on an average at around 5 crores. And the expensive ones within the project might go as high as 15 crores to 20 crores as well. But that's also a healthy proportion as far as the overall mix is concerned. In the ultra affordable, we are small. We don't do much there, but nevertheless, we have a little bit of that, and that accounts for around 6% of our portfolio. On the capital side, more than 70% is done through JDs, and the balance is outright purchase. So we always look forward to having a healthy mix of JDs, JVs, DLs, etc., along with the bought out land as well. We believe that while volumes and scale can be achieved quicker and faster and in a better way through JDs, but at the same time, we cannot underestimate the importance of having our own skin into the play, and hence we keep very healthy share of our own project, which are acquired and purchased on an outright basis as we grow. As we speak, we have taken up a total development of around 25.4 million square feet, out of which we have delivered just about 3.8. We will be delivering some this year or very, very early next year. But ignoring that, the components are 3.8 delivered. Ongoing projects account for 14.9 million square feet, and 6.6 million square feet is planned. So this is how 25.4 total is stacked up. When I say planned 6.6 million, they are firm projects. Either they are the phases of the ones which are already launched per se, and the subsequent phases are lined up for launch, or these are lands which are already either acquired, they have come into our name, or definitive agreements have already been signed and part payments have already been done. So this is how the project pipeline pans out. I think a lot of these details will be available in the investors presentation, which has been refreshed recently, today itself, and you are encouraged to go through the presentation. This will have quite a bit of information on specifics about what kind of projects, where, and how individual projects are stacking up, etc. A little bit about what are the key sort of strategic pillars that we have in our business. One is the asset-light model, and as I said, 70% is JDs. We have a very balanced risk profile. When I say balanced risk profile, it is on multiple counts. One is that we have been managing our debt at a very, very reasonable levels. So we have always kind of targeted to keep debt equity at below 1. I mean, as we speak, the way business has evolved in the last 7-8 quarters, the cash flows have been exceptional, and hence we've kind of wiped out our entire debt and we're sitting on some reserves. So net debt actually is negative. But nevertheless, as a policy, we know that we will not be crossing more than 1 as debt equity. We have a very, very strong innovation cycle when it comes to products and market offerings and solutions, etc. Each one of our projects will have a very clearly spelled out innovation or something that surprises the customer in the form of one or the other USPs. Very, very customer-centric as an organization, and with some very, very strong governance and systems and structures in place. I mean, as a manufacturer from our DNA of 120 years, we know what it means to be having systems and regulations, etc., and the importance of having governance frameworks in place to be able to scale up the business the way we wanted as any other business that we have been doing in the past. So these are pretty much the 5 pillars that we have as our foundation. And the company really can boast of several of its strengths, which are like one of the very strong brand that we have in the cities like Bangalore. Bangalore is our second home, by the way. We employ thousands of people there in other businesses. The entire brand side of business and the retail side of business of the group is headquartered there. And there, of course, everybody would know us, so to say. and with a very strong Gujarati connection, MMR in Pune too is quite a familiar terrain for us. One of our businesses, early business, so to say, telecom, is housed and based out of Pune, and hence we know that market as well as a company or as a group, so to say. We have some very robust partnerships throughout our group, and even within, we're confident to say that, look, we've gone through all this and we know the market from consumer's point of view, from product point of view, and from regulatory environment point of view, and this is a time for us to take a bigger leap. And that's what we just started doing, and we acquired a large one as recently as this month itself. We'll obviously, we intend to have a very judicious mix of medium-term and long-term projects. We believe that some large parcels, if they are not too capital-intensive, are very helpful in sustaining the numbers and consistent cash flows, etc. That's what we've done in 3 or 4 large projects that we've taken up in past, and we are currently executing as well. So our philosophy is that we take up decent size of project where we can create value, we can create destinations. So project should be on its feet to start with. At the same time, as we progress through the project, it should create independent value because of creation of destinations, as we call it, as we move ahead and create disproportionate value towards the end of the project. That's what we have been doing, and that's what our focus has been, and that's what we intend to further consolidate. We have a very significant headroom to raise funds. We have had very healthy round of capital infusion. We have had some very, very strong cash flows, internal accruals, and at the same time, because the company, even while remaining within conservative norms of debt equity, etc., we know that there's a very significant headroom to raise fresh debt, and hence all these 3 sources are significant, and this investment cycle has been kicked off, and we acquired 3 projects recently, all of them large ones, and we're looking forward to closing a few more deals in the months to come. So that's pretty much how we look at it. Of course, SDFC has been a great addition. One of their nominee directors is on board, Vipul Rungta. Some of you must be knowing him, who heads SDFC Capital, is now a member of our board as a nominee director. We have a lot of expectations from this relationship because of some very, very important, vast, and varied kind of experience that a fund as big and as important as SDFC could have. With their experience, we not only hope to leverage on their knowledge about the business in general, but also about sourcing land, the kind of deals, and the kind of opportunity, because they are into this from a very different perspective and point of view. And they've seen this market from a wider lens than what any individual developer could see. So we are very hopeful that this relationship is going to be very, very fruitful for both of us. Coming to the specifics of this quarter now, the Q3 financial year 2022, fresh sales for the quarter is sustaining healthy. It is at 158 crores for this quarter, vis-a-vis 144 crores last year, which represent a growth of around 10%. But when it comes to YTD numbers, the growth has been very significant. The year-to-date number for fresh sale is 451 crores against 322 crores for the same period 9 months last year, which is a growth of around 40 crores. Just to recap, we had closed the last year for the first time with a fresh sales of more than 500 crores, 529 crores to be precise. And this year, in the first 9 months ending December 21, the fresh sale number cumulatively stands at 451 crores. One important parameter or variable that we always keep an eye on is the unrecognized revenue, which is material sold, inventory sold, but not recognized in the books of account. It has moved up from 762 crores as on March 21 to 1,030 crores as on December 21. This 1,035 crores does not include the share of sales out of projects which are happening on DM basis. Of course, that turnover, that sale figure, although it's there in fresh sale number, but it does not reflect in our books of account. There only the DMC reflects in our books of account, and that's how these numbers are calculated. And 1,035 crores does not include such sales. On collection side, it has been record kind of quarter once again. Against 105 crore collection last year, same quarter, this quarter we've collected 154 crores, a very healthy growth. Even on a YTD basis, collections have been extremely strong. Last year we collected for the year as a whole something like 192 crores in first 9 months. And this year, first 9 months, we collected 434 crores. The collection is pretty healthy. A little about net interest-bearing funds, that is basically debt position. We started last year, December, at 197 crore debt for the company as a whole, which is now minus 85 crores. So there's a delta of around 300 or thereabouts crores. We wiped out that debt, and we are sitting on reserves and surpluses as of now. This money is waiting to be invested, and we are very aggressively trying to deploy this money as soon as possible. And at the same time, we have to come back to the previous levels of debt and maybe increase a little more, because the capital side, the equity side has increased quite a bit, mainly on account of the profits, obviously, during these periods, and also on account of additional equity which has flown in from SDSC and promoters, etc. during the period. I'm sorry. A little bit of information about the last project that we signed, very recent project. It is a project in Pune, in a micro market called Bhugaon. This is a 35 acres of land parcel, which we are buying on an outright basis. The definitive deal has been signed. We have paid part money already, and preliminary diligence is over, and we are hoping that the final diligence and other things will happen at a brisk pace. But as far as finalization is concerned, the project is all done, and this is a decently sized project measuring 35 acres. It has a indicated saleable area of 1.3 million square feet if you were to develop only villas on this land. That's our initial idea, that we'll be developing villas there. We have had some great experience in developing world-class villas in multiple locations in Ahmedabad. We did that in Bangalore as well, and we believe that we can bring in disruptive innovation there in villa kind of projects. And there are so many avenues and kind of solution that we could bring into the market, and that's what we want to replicate in Pune. In this first large project, the first one was not that big as such. Just as I said, just about wetting the feet there. But now this one is fairly large, 35 acres, which have potential top line of around 700 crores. Just to explain a little bit about project pipeline. We have taken up, as I said, sorry. As on March 21, we were at 22.8 million total project taken up, out of which 3.8 was completed. Today, as we speak, the number has gone up to 25.4, out of which 3.8 is completed. And from the balance, 14.9 right now is under execution, and 6.6 is planned. So you can get actually much more sort of details on the investor presentation, which is uploaded recently. On the financials, post the completion method, earlier we used to recognize revenue based on part completion method, and now we are supposed to be recognizing only when the projects are getting completed. One word of caution here is that for a company which is not too big at this point in time, and projects are not as many as you could see in some of the other mature and bigger players, we'll always have these ups and downs when it comes to booking of sales in our books of account based on this accounting standard. So it always creates that sort of going up and down in the books of account. But nevertheless, for the quarter, we are at 42.9 crores this quarter against 44 crores last year. So it shows a decline of 3%. But when it comes to PAT, we've grown by 18%. At 5.9 crores from 5 crores last year, same quarter. PBT is also up by 21% to 9.3 crores from 7.7 crores last year. EBITDA, however, is a little down at 12 crores from 14.4 crores last year. So this is the quarterly numbers. On a YTD basis, the numbers are looking a little better. At 95.6 crores against 84 crores last year. There's a growth of 13% on revenue. PAT has grown by 28%. PAT has grown to 27 crores against 25 crores last year. PBT has grown healthy at around 15.7 crores against 5 crores last year. PBT, yeah. And PAT is at 11 crores, 11.1 crore to be precise, against a figure of 2.2 crores last year, YTD, December. So that's how the financial numbers have moved. The shareholding pattern I think I talked about the debt already, that it is debt equity ratio is minus 0.21, and on a net basis, our net interest bearing funds have now gone down to minus 85 crores, which is surplus money lying in the bank's account as we speak. Shareholding pattern remains broadly the same. A little dip because of preferential shares issued to STFC from 56.88% belonging to promoter and promoter group. It has come down slightly to 54.34%, and accordingly 9.51% has now gone to alternate investment fund from 0% previously, and accordingly the public float has gone down drastically from 43% odd to 36% right now. So that's pretty much the story. We have a lot of details which are given in various ways of slicing and dicing on our investors presentation, which can throw a lot more light on various things, project-wise, location-wise, type of inventory-wise, and saleable, booked, unsold, values, etc., etc. So I think it will be helpful if we go through those numbers, and we'll be happy to respond any specific detail that might be required still once you have gone through those numbers. So with this, I'm pretty much done as far as numbers are concerned, and maybe we are now open for any questions that might be required to be asked.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question at this time may enter then one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star then two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Dhananjay Mishra from Sunidhi Securities and Finance Limited. Please go ahead.
Hello. Sir, can you provide figure of the total launches we had last year vis-a-vis what was the sales booking last year in terms of volume, and also in 9 months the same figure, launches versus booking?
Sure. Ankit, you will take this question?
Yeah, I can take this question, but specific to the details are anyways available on our website in the investor presentation of last year. Nonetheless, I can read out for a quick update for the group.
So this year 9-month figure is not, I mean launch figure I was asking actually.
Yeah, so last year, this year 9 months or last year 9 months?
Yeah, both. Last year full year I am asking FY21, and this year first 9 months, which we have published 2.08 million we have already sold. So what was the total launch in terms of this year?
Understood. So last year total number, if you were to ask me, total unit, total booked area is 28,65,000 square feet, and in terms of value it is 529 crores for the full year as a last year, versus current year 451 crores for the current quarter, with the overall total value of 2 million, which is 2.08 million to be precise.
So last year you said 2.8 million we sold for 530 crore, and this year we have sold about first 9 months 450 crore for 2.08 million, right?
Correct.
Right.
That's correct.
Yeah. And coming to the upcoming launches, if you could talk more about this Bangalore project like Devanhalli and some other project like Oasis and Bilair, which is already going on. How is the sales happening, and whether we are on track to complete sales on time?
Yeah, I mean, there's a very detailed presentation there in investors presentation, which gives specifics about project-wise details in terms of the size, how much of what is there has been sold, and how much is sold this quarter, etc. But just to throw a broad light, in Bangalore or otherwise, there are 3 projects which have been acquired recently. One of the large one has been acquired in partnership with SDFC under the platform deal that we had, which is right now to the extent of maybe 50 odd acres already done. So 50 acres have come into our books, and we want to expand more than that, and we are trying to see if we could expand it by another 10 to 20 acres. But nevertheless, our initial idea was to do around 40 to 50.
Sorry to interrupt. Our Bangalore ongoing projects are all 100%, right? This Bilair, Edge and Oasis.
All 100%, yes.
Yeah.
There is no JV at this point in time, except for the first one, which is yet to hit the market, which is this Devanhalli project, which is essentially a plotting project in partnership with SDFC. So that is expected to hit the market in Q1. We have, for the first 27 odd acres, got the land use change order coming from the government last week. So we've crossed a major milestone there already, and I think we are on track to launch this very soon, in maybe by Q1 of next year. That's on Devanhalli. Then the second project we acquired is located at Sarjapur. This is a JD project, essentially a large villa development project. There also approvals, etc., are now in process. We have signed the initial definitive agreement already, and further processes are on, and the idea is to bring that also to the market in the Q1 itself. So we'll definitely, we hope that these two should hit the market in Q1 of next year, April to June period. The last one that we've just taken in Pune, obviously this will take time. The land use has to be changed, and it's a process of anything between 5 to 6 months time. So I think that project should be launched somewhere in the later part of the financial year. That's how we are placed. The rest of the projects are at a fairly advanced stage of execution, be it Bilair or Oasis. Oasis is about to be completed. I think we should be able to deliver it with a BU and occupancy certificate coming in either within this financial year or early next quarter for sure. Same is the case with other projects like Avishkar, etc. Upland is happening consistently, selling, building, delivering, handing over, various stages, etc. So other things are fairly at an advanced stage, and these 3, obviously, 2 of them will hit in the first quarter, and one, which is the last one, should hit in the later part of the year.
Okay. So we have the 5.8 million square feet unsold inventory from ongoing projects, and then we have about 6 million planned projects. So total about 11 to 12 million, which we will be booking probably next 3-4 years. So what is the our target in terms of booking, annual booking for this year? Because already we have done 2.08. So what will you target for this year, next year, or next to next year, FY22 or 24?
See, we don't have specific guidelines in terms of targets, specific targets and numbers there. But we definitely have a plan in mind, and that's what we have been pursuing. As you see from our numbers, we have been growing on vitals at the rate of around 30 to 40% most of the times. Investment cycle was a little subdued when the COVID started, and maybe we lost some 2-3 quarters there. But right now we're in the middle of a very aggressive investment plan, and that's how these 3 quarters have been added. So what we intend to do is to continue this momentum of sales, which is growing at a very, very healthy pace last few years. And that's what we will continue to do. Of course, it needs pipeline to be strengthened, and that's where the entire focus is. We are an conservative company when it comes to selecting a project, but once done, I mean, there is no stopping, and we want to hit the mark as fast as we can. That's how we're doing this. We take this business as more like a process industry where land is the raw material, hitting the market is the priority, and having no FG or lowest possible FG is the idea. So that's what we're doing. Building blocks are in place. We have aggressively acquired in the last 3-4 months, and in next 3 to 6 months, we'll see a lot of action happening. And we got funds tied up for that. And that's how we look at it. And all I can say is that we should be looking at a very healthy growth when it comes to fresh sales going forward, the way we've been doing the last few years.
And lastly, sir, last question.
We actually need to move on to the next question. There are several participants waiting for their turn.
Yeah, I'll come in queue.
Thank you very much, sir. Our next question is from the line of Kirti Jain, an individual investor. Please go ahead.
So thanks a lot for giving me opportunity. Congratulations for great addition into the business development activity, sir. We are seeing consecutively a lot of business development activity is getting added up by the company. So my question is with regard to the further business development activity. In your opening remark, you had highlighted that our cash, which is minus 85, I mean net debt, which is minus 85 crores, plus we have the strength in the balance sheet to lever up. What is the level of leverage you will be comfortable, and how much BD we will try to add further, sir, in next 12 to 15 months?
That's a very good question, and any investor would like to have a little more on this. I mean, historically, if you see, as a declared benchmark, we've always said that we want to be in the region of, debt equity of 1 or thereabouts. Definitely, we don't want to cross beyond 1. And the maximum we have actually achieved on ground is around 0.8. And most of the time, we hovered between 0.5 and 0.8 or so in the past. Now, with the enhanced equity base and capital infusion, etc., even if we were to remain at 0.7 or 0.8 and be having no debt, net debt on the book, today means that a debt raise of 400-500 crore rupees should be comfortably possible. Plus, we have a surplus, etc., which we are sitting right now on to the extent of 85 crores or 100 crores thereabouts. And internal accruals have been strong. I mean, sales engine is really performing. We've had a lot of focus on digital and on various sales initiatives, etc. So sales has been healthy. Projects are at a fairly advanced stages of completion in most of the cases, and hence there is a very significant cash inflows expected the way it has been happening in the past, few quarters. And that's how we wiped out our debt, so to say. But this kind of momentum is expected to continue for some more time, and all these 3 things put together means we have a decent amount of money on our hands to augment our pipeline.
Okay. So, sir, we would be, if I'm just doing rough math, sir, it translates to 500 crores of land acquisition, and that should translate to at least 2,000 crores plus of BD next year, sir. Is it a fair assumption? Or
I'm not able to understand what is the meaning of 2,000 crore of BD.
2,000 crores of, like, today you have given a project of 600 crores of announcement you have done, sir. At Baugo, like that 2,000 crores, can we expect in next 15 months, sir?
If we buy, of course, this 500 crores or whatever, I'm broadly guessing the same number or a similar number. All this money has to be invested in next 3 to 6 months' time, for sure. I mean, this is not, this is a short to medium term plan. If 6 months to 8 months is a short to medium term plan, if it is called so. So yeah, this entire money has to go there. Now, it really depends upon what kind of product and project we do. Sometimes there can be, if you were to figure out the top line, sometimes the ratio could be 100 crore investing will give you a top line of 700 crores, 800 crores. Sometimes it could be 500 crores as well, depending on what you want to do with that money, what kind of project coming in. But the way we are doing, we are focusing more on horizontals for the last few quarters. We have a very clear focus on horizontal projects. So you want to do projects which are villas, plots, or which are at least not very heavy on FSI. And that's for many reasons that we do. And we continue to do that, then the ratio could be something like 1:6 or 1:7. So a 500 crore investment should be giving us in excess of 3,000 crores of profit.
Sure, sir. Sir, your strategy is very interesting. Like, why you want to do more of horizontal, sir? Like, we are hearing from other companies who are listed, all talk about only vertical, 50 floor, 40 floor. What is the thought process of about that? If you can give some idea, that would be great, sir.
So, I mean, it's not that we don't do high-rise. We have projects which are 22 floors, which are, a lot of them are 15, 14 floors, 14 meters, 17 meters, etc., etc. We haven't really done some 100 floors. But yeah, I mean, below that, 60 meters, 70 meters, we have been doing for sure, and that has been our core for a long time. But, you know, I mean, we always have put a lot of focus on large horizontal developments in the past. We have developed a very, very strong capability there. But, you know, what we want to offer is not a function of what we are experts in. What we need to be taking to the market is what the market needs. And in our understanding, horizontal has been a little ignored in this country as a whole. If you go to any other developed economy, you will see that there is a core part of city. There is a CBD where you will see a lot of high-rises concentrated in the middle of everything. And then as you start going out, the areas start becoming more residential and more horizontal and spaced out and panned out. Now, this focus has been there as far as we are concerned. And it also optimizes the risk element into the whole thing. The degree of investment or exposure in construction in such project in relation to the land value, the ultimate profit targeted, and the top line generated is healthier in case of horizontal development, and hence the operating leveraging, so to say, is significantly less, and it optimizes the risk profile on the project side. So we have a general, affinity to horizontals. That strategy has paid off. But having said that, we do quite a bit of vertical as well. I mean, going forward, if you were to deploy X, then I think 60% of that or even more could actually go into horizontal development.
Okay. So last two.
Mr. Jain,
okay. Thanks a lot for the.
Thank you.
Thank you. Ladies and gentlemen, before we take the next question, we'd like to remind participants to please limit your question to 2 per participant. Our next question is from the line of Prem Khurana from Anand Rathi. Please go ahead.
Yeah, thank you for taking my question, sir, and congratulations, very good set of numbers this quarter. So my question was, I mean, just to continue on what the previous participant was asking, I mean, basically on the business development side. I just want to understand your thought process, I mean, the way you would like to approach this new acquisition. So the idea would be to kind of add more in the existing markets, or would you be open to look at new geographies as well? Given the fact that now we have liquidity in place, you also have HDFC platform to be able to kind of use it to your benefit. So the idea would be to kind of strengthen your leadership position in the existing market itself, or you would like to kind of look at new micro markets as well.
Great question. I think this is a question we live every day, every morning, every evening. And the answer is fairly consistent. We have gone fairly deep in the markets of Bangalore and Ahmedabad, if we include Gandhinagar in Ahmedabad only. They are twin cities. But still we see a huge potential. I mean, if you do 4 or 5 projects in Bangalore, that's nothing. We could easily do 15. So on one side, we have a very, very small base, as we call it, and we have a significant sort of headroom to go deeper into these 2 core markets. But we know that in the medium term, we can't be a 2-market company, right? So we need to expand, and we have realized that a few quarters back. That's why we took up one small project in Pune to understand the environment there, as I said before. And now is the time that we, having received and got this confidence of knowing the micro market, we have started investing heavily in Pune and MMR. When I say MMR, basically it's the outskirts of Mumbai. So Pune and MMR we are treating as one market. Bangalore as our one market. And Ahmedabad, Gujarat, Gandhinagar, etc. is the third market. So having done 2 in a reasonable way, right now the focus will be, or a good proportion of our fresh investments are now flowing into Pune and MMR region, which is our third major city. So in the medium term, I think we'll have enough and more to do in these 3. They should give us enough and more room to grow and invest in. And once we've done that and we start feeling the same way as we did, having done 2 markets, and then we entered into the third one, and we will start exploring 4th. But at this point, we are focused on these 3, and we'll continue to go deeper into these 3 markets, and that's how it is. We will continue to be a little more conservative about expanding horizontally in the sense of it. Going deeper is a better strategy. We want to be of a very, very decent size in a market that we operate in first before we venture out in the next market, so to say, in terms of geographical expansion.
Sure. And so when you evaluate new transactions, so how do we decide on which project would go under HDFC platform? And if it is, as well, it is a mid-income or affordable, which is what the mandate is for the HDFC platform. So let's an opportunity in the segment. So how do you decide, whether you would want to do it on your own or you would offer it to the HDFC platform, or is it that, you have the right to kind of offer them and then they can evaluate?
Sure. So from where where we stand today, as of now, it's up to us and HDFC both to jointly do a project or not do a project. So if both of us agree, it can be done. If one of us don't agree, it cannot be done. Like, for example, the Pune one is being done on our own. We are buying as a company, and there is no other partner, so to say. The HKR One fund, which created this platform, is done. They've completed the investment cycle of that fund, and that fund from fresh investment and commitments point of view is over, and hence that platform deal is done. The second phase of our partnership with HDFC has brought in extra money, but that has come in the form of equity into the company, and hence it's not project specific. They picked up a stake there, and hence what to acquire and what not to acquire obviously is an internal issue within the company. Now, HDFC has recently announced, as I understand, 2 days back, the HKR 3 fund, which is a huge fund. It can reinvestment go as high as $2 billion or thereabouts. Now, that's an open discussion, and obviously, given a very, very strong relationship with HDFC as a group through various sort of arrangements, platform, equity, etc., we'll keep exploring how and where and when we can invest together.
Sure. And just one last from my end, if I may. So let's say, if you, you want to kind of further broaden your presence in the markets like Bangalore and Pune. Generally, what we've seen is that most of these developers, whenever they're planning to explore new micro markets or new markets, they generally tend to kind of go for JD projects, because the idea tends to be, you would not like to go to a market where you don't have expertise or you're already not present in that market because you don't understand the system well. But for us, I think it seems as if, when I look at Pune that you've done now, the Bukum, it's entirely 100% yours. So how does it work with us? You're kind of okay to go solo even if it is a new market, or the idea would be to kind of try and de-risk and go with some partner early? Whenever you are planning to enter a new market, and then once you have some name established and then look for solo projects, or you're open? Either way you're okay with it as long as you're able to make good with the project.
Great question, but the answer is very counterintuitive, so to say. I mean, if you are expecting one way on this strategy, we believe the other way around, that if you are exploring a new market, it's better done with your own funds first, because then the variables to be controlled and the dependencies and the relationship risks are less. With your own money, you can clearly focus on delivering something to the customer unhindered, and with the kind of specs, whether or not we make money, because when you have your own money invested, you can take calls, which otherwise you will not be able to do. And first thing, at the time of entrance into a market, which matters the most is to make sure that the customers are happy. Now, we don't want to be having constraints there, and that's why we would rather do our own projects to start with. But having said that, de-risking our own investment is very key, and that's why we are very, very conservative on investing our own funds into a new market. And that's why we are not in 10 markets today. We are only in the third market that we are entering at this point, after having done 2 in a big way the last so many years. So we believe that it's safer to be on your own first, deliver the value, deliver the promise, and make sure that the customers are happy before we take any chance with the customers. One, in any case, we can't take that chance, by the way. And more importantly, relationships with the investors or the landowners is as important as our relationships with the customers. I mean, if you think that you're not mature enough, then we have no right to be playing with the value and the lands and the money of somebody else, and put that relationship and track record in danger. We boast of some of the healthiest relationships with various stakeholders, including landowners, and that's what we want to further consolidate. In fact, unless we are sure and doubly sure about success of a project, both in terms of markets, the products, and also our capabilities, we won't rather take any chance with somebody else's land for sure. In fact, it comes later.
Sure. Thank you. That's it from my end. All the very best for future. Thank you.
Thank you.
Thank you very much. Ladies and gentlemen, before we take the next question, we'd like to remind participants that you may enter *1 to ask a question. Our next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hi, sir.
Yes, you are, sir. Please proceed.
Okay. So, is it fair to say the booking value of this quarter, is very much sustainable now, and now going ahead, we would be keep on growing this number?
Well, that's the whole idea. We have been growing at a very healthy pace, and the last 2 quarters have been great. And that's why we are pumping a lot of our investment into new projects in pipeline. Building blocks are all in place. And if we continue doing the kind of investment we've done the last couple of quarters, I think we are on track to, kind of sustain these numbers on sales. Of course, real estate projects, when you acquire them, some of them take 3 months to hit the market. Some of them might take 8 months or 9 months to hit the market. But I think important is that even if there are launches happening at a discrete sort of pace and points, important thing is that the pipeline has to become bigger. That's where the focus has been. And we are very, very aggressively working on that. The cycle has been revived with a very, very different kind of rigor and vigor, which was not the case in the initial part of COVID. So we are trying to make it up, cover up the lost time, and of course, the environment has helped us with very strong approvals and fresh equity and debt getting raised, so additional debt to be raised, etc. So I think we, on a long-term basis, medium-term basis, we are poised to strengthen our sales. And the sales engine, by the way, is working. A lot of building blocks behind this. But I think we have a very, very strong team, which includes the call centers, virtual sales, the digital setup, and I think we have one of the most advanced IT and technology stack behind whatever we do on the sales side. The sales paradigm has changed dramatically in the last 8 quarters. The way houses were sold and the way real estate was transacted, I think there has been a sea change. In certain aspects, I think we've even crossed some of the developed markets when it comes to the tools and tackles available for an effective sales engine to perform as a country, as a nation. I think at Arvind, we have been very, very savvy, tech-savvy people, and we have a very, very strong technology stack going behind the sales. This thing. So I think we are very well poised to continue our growth in the fresh sales parameter.
Okay, that's great. And my second question is, sir, you are mentioning your PPT around, the operating cash around 1,500 crores. So if I say approximately, how many years can this be realized?
So, there'll be a couple of additional slides in the investor presentation. Most of our projects are getting over between 1 year to 3 years, 3.5 years time. So most of what you are reading here from the list of projects which are already launched, they should all be done within a span of 1 to 2.5, 3 years time from now. And the new ones, assuming that they will be hitting the market in next 6 months, maybe 3.5 years thereabouts to complete the project. So mostly these are 1 to 4 years, averaging maybe 2.5, 3 years, something like that. Yeah.
Okay. That was helpful, sir. Thank you very much.
Yeah.
Thank you. Our next question is from the line of Ritvik Sheth from One Up Financial. Please go ahead.
Yeah. Hi. Thank you for the opportunity, sir. So most of the questions have been answered. Just a couple of questions. Firstly, you mentioned MMR. So are we? So is it at something is at an advanced stage? Are we looking to launch any new any project in this calendar year itself? Anything at an advanced stage?
So we, as I said, we treat Pune and MMR as one market for us, so to say, from a region point of view. And obviously, we're actively looking at the entire belt from Pune to Mumbai or that side, outskirts of Pune and some other outskirts of Mumbai as well. It has so happened that we are able to close the first major deal, this Concall deal of 35 acres in Pune. But of course, we are actively looking at options within Pune, outskirts of Pune and outskirts of Mumbai. So, this is a binary situation. Next one could come from Pune itself. Next one could come in the outskirts of Mumbai towards Pune or vice versa, etc., etc. But yeah, within this region, we will definitely be adding a few more projects in the future.
Sure. And sir, in one of the earlier questions, you mentioned about a new fund from the HDFC platform, which is for 2 billion. So can you just rephrase this? What is this related to? So do we get
this is just a market information I'm telling you and sharing with you. All I wanted to say was we got investment from the first fund, HDR1 fund, into our SPV and also into our parent company. They are now coming up with the second project, which they have announced in the market a couple of days back. It's a huge fund. So that's just a market information. Nothing to do with Arvind at this point in time as far as that fund is concerned. It's a generic fund which they've raised and announced in the market, and possibly they'll have plans to start investing from there.
Right. So potentially that could come to us on the SPV platform. Which
they've been investing in various ways with us.
Right.
They have been investing in various ways with us, including platform and company level through fund, through various kind of structure that they have within their setup. So obviously, we'll definitely explore with them in terms of what more we can do from this new fund and otherwise.
Sure.
HDFC as a group has been a credit provider also. They have been our number one banker all through this journey of almost 7-8 years. They are the prime lenders to our business at SmartSpaces. So in multiple ways, we have had some very fruitful and strong relationship with them. So obviously, we hope that it will further consolidate, and we'll keep exploring partnerships as we go forward.
Sure. And sir, two big questions from my end. What would be the land cost for this Pune land which we are going to acquire?
It will be less than 90 odd crores thereabouts.
Okay, 90 crores. Sure. And so the estimated operating cash flow that we have mentioned in one of the slides, so that would be at project level, right?
Sorry, which number are you specifically kind of referring?
The slide which mentions the operating cash flow at about 1,500 crores in the presentation.
Yeah. This is net cash flows to us after accounting for lands, the share of landlords, all the expenses for development, overheads, and everything. So if you were to take out every single thing, which is out of pocket. This is net of everything which remains with us.
At project level, right?
This is at Ankit. Can you explain this a little more technically?
This is after allocation of corporate overhead. So this is a net EBITDA for the company.
Wow. Okay. Sure. That is very
for sure. This is net of overheads. Overheads,
that is what I was trying to understand.
Now, this is the money that we see in the business for us.
Wow. Great. And so just one last comment or your view on this. So if I look at the projects that we have done till date, it's about 2,500, 2,700 odd crores of cumulative, ongoing projects in completed and ongoing projects, where we have unsold value of inventory and also the booking value about 2,700 crores. And you mentioned earlier that in next 1 year we're looking to invest about 400 to 500 crores if we get the projects, which could have a multiplier sales value of 5 to 6 times depending on the type of the projects that we acquire. So we're talking about 2,500 to 3,000 crores already incremental projects from this cash flow. So just one question on this, are we ready in terms of bandwidth to handle this level of projects, and what needs to click over the next 1 to 2 years?
Understand. So just one small flag here. This ratio of 1:5 or 6, whatever. So if you invest 500, it means 3,000. That is also based on an assumption that we buy out all the land parcel that we invest in.
Right.
So 100 crores spent means an outright purchase, and which results into this kind of a turnover. But obviously we'll also have a very significant component coming in from JDs.
Right.
Sarjapur project, for example, has an upfront investment of 15 crores, giving us some 700 crores of top line. So that changes numbers dramatically. So 500 crores is not entirely for outright only. So a 50-50 breakup of these funds, and maybe that's too high. You can say even if it is 40% going towards JDs and 60% on outright, that will mean that the number of 3,000 crore for a 500 crore year mark will go dramatically up in terms of top line. That's one flag I wanted to raise. On your question of bandwidth, that's extremely important. End of the day, on the business side, any business, I think the primary constraint is the bandwidth or the managerial capabilities and talent pool, etc., and not money and not land. Of course, land is abundant, isn't it? So we have been very conscious about it. We have been building teams way ahead of our time. We think that the first investment that we need to do, even before we invest in a piece of land, is to invest in corresponding and even little more on the manpower, on the managerial capabilities, etc. That's how we have evolved, and that reflects in our delivery so far. We have had one of the best sales in, as we understand, on a small base. We have delivered every single project on time, and we have been quite upfront about investing in people. Today, as we speak, we have had some very, very senior and very, very experienced, very, very dynamic set of people joining this company in the last 3 to 4 quarters. Ashish himself is an example of that. Birla and Cottage, etc., who joined us as COO. We've had head of our national sales who joined from Lodha, with a very, very vast experience into Mumbai and Pune market. We knew that our new focus is going to be these markets, and we're fairly established in other markets in any way. So we have been Ankit himself has joined from a very, very strong finance and structured systems-oriented background from Marico as a CFO. So we have been building teams in a very, very big way. And of course, upfront. We don't want to be behind the curve on building teams and just mess it up in everything. We'd rather be a little ahead of time and invest more than invest less on this.
Sure. That's very encouraging. Thank you, sir, and all the best for the coming year.
Thanks.
Thank you very much. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Kamal Singhal for closing comments. Please go ahead, sir.
Great. So good. It's been great having time spent with all you guys, and thank you very much for sparing your valuable time. Last few quarters have been great. The momentum has been great. We see extra tailwinds coming our way because of the way industry is evolving, consolidation happening, general mood being better, buyers more inclined to buy more and buy bigger. Market is driven significantly by end consumption. The element of investment for the investors into real estate is significantly less. That means less ups and downs and more stable and sustainable kind of growth. Prices haven't really gone up for real estate. Affordability is at its best. So, we believe that India is poised for a very, very strong next few years when it comes to real estate. There is no bubble like Evergrande happening in India. Most of the developers are very well capitalized, at least the kind of people that we deal with. And hence, it's a very stable market when it comes to both the demand side and the supply side. So we take this as a great opportunity. We think that we have all the building blocks in place, and we're very aggressively right now focusing on building our pipeline. And of course, we'll be investing upfront and heavily in technology, in our systems and processes, which are obviously one of the most evolving industry as we believe it. And we'll keep strengthening our governance structures, which are possibly one of the finest in this industry. So all in all, we're looking forward to a great and exciting period going ahead. And I think many of us, our peers, will be feeling the same way, and they will also be able to kind of show the kind of numbers and results that one would expect from this segment after a comparatively longish cycle of not something happening in a very significant or great way in the past. So all in all, great. And in the end, thanks a lot, everybody, for joining us, and look forward to meeting more often with you. Thanks a lot.
Thank you, Mr. Singhal and members of the management team. Ladies and gentlemen, on behalf of Arvind SmartSpaces Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your line.